Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And I'd like to start by reviewing the forecast that I put out last week so you can see how the market played out and how well the technical signals are actually working. As I zoom in here, you'll see that this diagonal line is the projected trend that I put out a couple of weeks ago actually, and the market followed that perfectly. Remember, my target price was the gap fill point. That's what this line represents here. Horizontal line is the gap fill point. And if you've been following along with the market guys, the gap is more or less a magnet on the price chart, and it draws prices back to that point, and 80% of the time after the gap fills, it bounces. And that's exactly what happened. The gap filled here on Tuesday. On Wednesday, it pivoted higher. On Thursday, it gapped up again. And then today, Friday the 9th, we had a bearish engulfing pattern. So what I'm going to do is I'm going to erase this particular line right here, and I'm going to redraw this line so that you can see the projected forecast for next week. And I think what's going to happen is the market could very well drop back down to test this support, and in the process fill the gap that was left on Thursday. So be very careful of any long positions you have. I am not taking any new long positions. I am protecting and actually looking to make money on the downside. So that's the diamonds. Now if you look at the spiders, that's ticker symbol SPY, you'll see that a similar pattern formed when the market dropped right in line with my projected trend line right there, or down leg. And this one followed it like a textbook. It just went right down, followed that line, filled the gap once again, tested support, and bounced. So we have a gap on the spiders as well with, it's not quite a bearish engulfing pattern right there, but it's a long red candle on higher volume. If you look down here, the volume bar is pretty strong for the sellers. So if you look at the Russell 2000, which is a more broad-based index, you'll see that we have a turnaround point from the resistance that I put out last week. Market came down perfectly, filled this gap as well, bounced off of the 200 period moving average, and I do believe that this too will start to move lower as it fills the gap, and maybe even retest this 200-day moving average as a support level. So here is the projected line that I'll put for the Russell 2000, looking something like that, and we'll keep that in place so you could reference that the following week, and again use this as a guide to help you understand how to forecast the market using simple lines like support, resistance, and trend lines. So you know, the NASDAQ market is represented in the Qs. That's the triple Qs, also known as the power shares. And like clockwork, and like the other indices we looked at, the forecasted trend was not quite the same angle, but it was the same idea where it came down, filled the gap, tested this role reversal line, bounced. And what I'm going to do is erase this now and redraw what I think is going to happen with the Qs. And if you notice, there are lower highs forming here while the lows are maintaining a strong level of support. So it's too early to tell whether or not the market's going to break down below that support level. We have to actually wait to see if it breaches that line, and then we have a whole nother game plan, because if it breaks down below support, we can see prices a lot lower. But again, it might be too premature to forecast that. I'm using short legs, if you will, to describe what's going to happen next week, and I think that'll be good enough for you swing traders and even the day traders that are out there. Investors, all you have to do is change the charts and look more weekly or monthly charts, and you could do the same thing. You're just not going to get in and out of the market like some of these more active traders are. But you can use this as a risk management tool to prevent a catastrophic loss and help you get out of some of the long-term investments that are looking bearish right now. The VIX is something I talk about quite often. And again, this is a contrarian indicator to the S&P 500. This was the leg that I drew. The market came up. It filled the gap on the VIX here, right there. But then at the same time, it gapped down on Thursday. Remember, if the S&P gaps up, the VIX is going to gap down. And I think what's going to happen is the VIX is going to maintain this short-term leg trend line as an area of support. So I think as the VIX goes up, the S&P could start moving lower. Keep in mind that the Market Guys is your educational provider here with regard to financial education, and we have a video tab right there on the front page of our website, and that tab, when you click on it, will bring you to the library. Please make sure you are going down the list and reviewing some of the things that I've just talked about. For instance, I talked about the gap. This is a great video on how to trade the gap, and it really outlines in very short format, maybe 3 or 4 minutes, how to incorporate that strategy into your own trading plan. We also talk about the role reversal. These are the lines that are so important with regard to forecasting and also managing risk. And some of the other things that I talk about are right there on that library page. We continue to develop our educational content for the general public so that you can continue to visit us and learn more each and every time. We don't go through very intense study. These are very short videos that will allow you to get your daily financial vitamin. So make sure you go to the Market Guys and look into that. So that's our weekly market report. Make sure you keep your stops in place. Use protective measures with regard to your risk management discipline, and we will speak with you real soon. Have a great weekend. Bye-bye.